If you're wondering why we have a statement of cash flows, this video will explain what a statement of cash flows can tell us as we peel away the layer of accruals in our firm's accounts. The statement of cash flows shows the movement of cash into, out of, and within a firm. Cash is more than banknotes and coins held by our firms. It includes money in bank accounts, which a firm can withdraw whenever it likes, demand bank accounts. And it also includes cash equivalents, which are short-term, highly liquid investments readily convertible to known amounts of cash and which are subject to an insignificant risk of changes in value. The statement of cash flows helps us assess the ability of our firms to generate cash and their need for cash. It does this by removing the accruals in the other financial statements of our firms. Accrual accounting involves judgments, a lot of judgments. And one thing about judgments is that they are subjective. In the same situation, different people tend to make different judgments. And who are making the judgments? Management and their accountants. Management might be tempted to use a firm's financial statements to tell stories to stakeholders, rather than simply tell it as it is. With cash, there are no judgments, no assessment of the economic substance of a firm's transactions and other economic events. All there is cash. A statement of cash flows classifies cash flows into operating, investing, and financing activities. The format of a statement of cash flows is cash flows from operating activities, plus cash flows from investing activities, plus cash flows from financing activities. This equals the change in cash for a period, plus cash at the beginning of a period equals cash at the end of a period. The statement of cash flows sheds light on the questions: how did our firm's cash balances change or move from its opening balance to its closing balance? The three categories of cash flows are defined as operating activities, which are the principal revenue-producing activities of the entity, and also other activities that are not investing or financing activities. Investing activities, which are the acquisition and disposal of long-term assets and other investments not included in cash equivalents. And financing activities, which are activities that result in changes in the size and composition of the contributed equity and borrowings of the entity. Each item in a statement of cash flows is usually shown inclusive of GST, and this is required in Australia. For further information on the statement of cash flows, go back to Chapter 7, Sections 7.1 and 7.2 in the study guide, and also review the Statement of Cash Flows weekly questions. Also answer, write and rate questions on liabilities in Peerwise.